big question is, will D Street repeat the 2022 streak or not, given the kind of macro construct which is very, very different than last year?
Look, you talk about what's happening in the market, and if you look at the market purely from the prism of, let's say, the short term, last couple of days, you found support at lower levels. Despite FI selling, despite a marked deterioration in macros, and even though the dollar index and the commodity prices have not really been on the right side in terms of the macro positioning, I think markets have done fairly well. Why are markets doing fairly well when FI flows are not exactly very conducive? You've got patches of big block deals and nothing big in terms of a follow-up. I get that's largely because of the support of the local money. And the positioning of the market, I think, is evident. Let's look at it. Let's look at, these are support levels from where market has found, has managed to bounce back. Now that's the market positioning for you. From the recent high is what we are talking about. Nifty is down by about 3% and the bank Nifty is down by about 5%. But you flip it around with the small cap index and the mid cap index, I think there is a very big divergence there. And that divergence, I think, is what we need to bring out. That FI dominated sector like banks, it's not done well. FI dominated sector are coming under pressure, but retail dominated sector and sectors which are dependent on DI flows or HNI activity, those indices I think are holding on. So the mid and the small cap index has hit an all-time high, and at a time when in general the global macros and the declining trend in the bank Nifty is there. So what could be the scenario? We put the setup that this is how things are. Now what could happen? If global macros continue to the way they are, I think it's a matter of time that bulls will blink. I don't think you can go completely in a different orbit. But if global macros improve slightly, then you actually could see a sharpish bounce in the bank Nifty. So in cricket terminology, there are times when you play in the front foot. That period is over. There are times you have to defend. I think that is what you should do with large cap stocks. But there are these odd swing balls you should leave. And I think those odd swing balls are there in the small and the mid cap space.
Yeah, but I think the question is, what's going to cave in first? Are mid caps going to follow the large cap trends, or large caps are going to run up once again as they did last year?
Mid caps are supposed to trade at a discount to large cap. That's the reason why. Traditionally how it is. Right now we are in that phase of the market where discount is over and large part of the mid cap market is trading at a premium. For mid cap stocks to command this kind of a premium, growth has to be supreme and macro conditions and liquidity conditions have to be benign. I don't think that is the situation. That may be the situation. So to imagine that this kind of a premium will continue in mid and small cap stocks is unlikely. That means either these stocks have to come down or large cap stocks have to stabilize. I'm purely speaking out of experience. In general as a category, of course, you will have individual stocks where different factors are at play. But in generally, since we're looking at categorization.
Yeah, but since you're speaking about global macros as well, it's pertinent to note that you did see the 10-year Treasury yield in the US hit a high. This is of 4.35%, and that's incidentally the highest level that we've seen since the year 2007. So it was up by more than 9 basis points and it traded at close to those 2007 levels, over 6 basis points higher than 5%. You had a mixed close coming in for the US markets, but just going by what these cues indicate, Nikunj, what it could spell for the overall macro picture.
See, interest rates, they act like gravity. Interest rates, they go higher, markets have to come down. So far, markets have ignored that. And I'm talking about pure global markets. If markets are ignoring interest rate surge, which is the 10-year paper and the 2-year paper, it means that bond markets are telling you that rates are going to come down and Fed is unlikely to increase rates. Now, that scenario, this kind of a setup was actually not there, was there in 2021, October to December, when interest rates, they started moving higher and global markets, they ignored it, and then inflation became unmanageable and then it really became a challenge. Are we reaching there yet? Well, not there yet. But one factor which you cannot ignore is that if yields, they go higher, growth stocks, they tend to underperform. And I think for me, the first indicator which could come of a risk of trade from the global market would be Bitcoin and NASDAQ. I think those are the two factors which would monitor. I see the following purely based on what I've learned and understood over the years is that in US, the inflation concerns and the bond yield surge, I think, is because of different factors. It's There are a lot of other factors, the recovery in US market, labor economy, what is happening there. But in India, the inflation is a function of tomato prices, vegetable prices. So while the sell-off at a macro level will soon happen because of inflation, Indian markets will go down, but then everybody will realize that they have a different factor at play, we have a different factor at play, and then markets will start stabilizing. You know, like they say that history rhymes.
Yeah.
I think we are going to see that same rhyming
Narrative repeat.
happening,
Yeah.
because just, you know, the setting is so similar to what we saw in December and November 2021.
Although this morning the handover from the Globe seems okay, so let's see which way we actually head and what the GIFT Nifty is indicating. A bit of a mixed bag actually for the US markets, if you will. About a 0.6% gain for the S&P 500 index, in the green for the Nasdaq as well, but not quite for the Dow. Asia is a lot better than what it was yesterday, or for that matter, the US handover as well. Pretty much across the board, you are seeing gains of about 0.5%. A lot more tempered, of course, for Shanghai, which is just about marginally in the green as we speak. What's the GIFT Nifty then indicating? Again, a very, very flat start for us, just skirting around that 19,400 print. Although talking about individual sectors, Nikunj, given the kind of demand surge that we've seen within power consumption, these power stocks are flying high.
You know, it's an extraordinary surge, and this is like much higher than what the summer forecast is. I mean, normally you assume that it's only peak winter, peak summer, the forecast, the energy
Surge.
demand or power demand would be the highest. But right now that is not the case. It's largely because of maybe the humid weather in parts of India, or simply what is happening to the economy. The demand has hit an all-time high. And the numbers are, summer forecast was 230, August record high is 234. But what is important here is that the impact of this sudden surge, I think, is something which will have an immediate impact on the power prices. Now, there are two ways in which you sell power. One is PPA, where you have entered into long-term contracts at a state level, at a central level to supply of power. Then second is that additional power, if demand surges, the companies or utilities, they actually sell in the open market. And that's where the change, I think, is evident. So if one has to understand the linkage here, I guess this demand is too high to sustain. But if demand is high, somebody will make money. Who will benefit because of that? And I think that would be utilities. And companies which have an existing capacity and who have ability to sell outside those PPA, they are the ones who will make money. So for example, in the near term, Tata Power, NTPC, perhaps JSW Energy, those are the companies which would benefit disproportionately. However, what you don't want to do is that you don't want to think that, okay, just because power stocks are up, you want to buy, you know, the entire ecosystem per se. I think this is a temporary phenomenon, and in the temporary phenomenon, the best way to do this is that you bet on utilities and power producers, those of existing capacities, rather than those companies which have a promise of future capacity addition.
All right.